This is Satya Pradyuman of Cirrus Research. The latest issue of the Signals Report is just out. This is our asset allocation report that looks at stocks versus bonds, large versus small, growth versus value, etc. The title of this report is Bond Correction Fails to Fade Equities. And a lot of things go into this sort of takeaway. Part of this has to do with the fact that the profit cycle that's been slowing, we're starting to see hints of stabilization across the West. If you look at our stock versus bond allocation model, that model had been squarely overweight equities. What's interesting though is even with the sharp run up, especially among those few stocks, what we're seeing is an exposure that's still about 60%. Remember, the long-term average of the equity allocation here is about 49%. So this remains firmly in place, given the fact that we've seen such a strong run-up, especially among the largest tech names. You would think that this would begin to fade the equity allocation. I do think, though, that in some of the work, especially our latest quarterly report, we referenced the fact that the profit cycle is indeed stabilizing and estimates are starting to ramp up. So it is really hard to see a risk asset such as stocks begin to fade much lower, given the fact that the earnings environment's improving and the Fed potentially is on pause for a while. In addition to that, we've spoken a lot about leadership and the break in leadership. The question is, how violent could it be? A couple of key tactical signals give us some color. Number one, the risk appetites that we measure in the US equity market, they're still benign. And this is important because if we were to get a break in leadership, the reality is that if this reading was excessive and severe, we would likely see more of a sharp break. Given that it's more normalized, we're unlikely to see the sharp break even as we see a change in leadership. The other element has to do really with the crowding factor. The crowding factor had begun to creep up about 3-4 months ago. That has suddenly reversed course. Part of this has to do with the sharp pullback, the pickup in bond yields. But what this is telling us is that you don't have the severe crowding that we can witness. And so these are elements put together that says, while we believe there is a break in leadership, a change in leadership underway because of the profit cycle, it seems as if that this time around it may not be as violent as we originally would think. With any questions, feel free to call us. Thank you.